Kia ora, and welcome to the CoreLogic Property Market Update for August 2020. Just as we were getting comfortable, we now have our first cases of COVID-19 community transmission in over 100 days and a move back up the levels. Of course, we all hope it's a short and sharp return to having restrictions in place, and once again, it's too early to know the full impact of the part shutdown. But a general theme is likely to be seen in a loss of confidence and a longer period of cautionary policies, including tight border controls. We've still got plenty of info to cover this month though, focusing on how the market was recovering from the earlier lockdowns and how things are shaping up for the rest of the year. Firstly, with property values. And resilience is probably the word of the month. The 3-month value change, according to the QV House Price Index, illustrates that while the strong momentum in the market has been lost, values have essentially held flat since we exited the strict level 4 lockdown at the end of April. Of the main centres, Dunedin and Auckland have seen minor drops in value over the last 3 months, with the opposite the case in Wellington and Christchurch. Hamilton has experienced a wee bump in values in July, taking the quarterly increase to 0.9%, while Tauranga's quarterly figure of 2.5% is the opposite, as the 2-month change is only 0.2%. In other words, Tauranga was doing a bit better earlier, but has since faded a bit. For the next tier of main urban areas, the resilience trend is also evident, with only Queenstown showing any signs of genuine weakness. Values are down 4.2% in the last 3 months. Rotorua provides perhaps the biggest surprise, as there appears to be no loss in momentum, with values up 6.7% over the same period. So while these two touristy centres are often lumped together, they're performing very differently. It's more complex than the split of where the tourism dollar comes from, but the fact that 65% of all tourism spend in Queenstown comes from international tourists, compared to only 40% in Rotorua, does go some way in explaining the divergence. Looking deeper into value change provides more insight into the variable performance of the market. The upper tier appears to have suffered the most, reflected by a 10% drop in value for properties above $1.6 million in Queenstown, while the rest of the market there has only seen a 4 to 6% drop. Similarly, in Hamilton, a market which has shown greater resilience, values have continued to grow at the bottom end compared to flattening at the top end. This will be reflective of demand remaining relatively strong at the mid to low end of the market, as first home buyers and investors remain active, while other owner-occupiers who may have otherwise looked to move house sit tight. We can see this in the CoreLogic buyer classification series, where a comparison of buyers pre- and post-COVID lockdown at the end of March shows the lift in share of sales going to investors, both mortgaged and non-mortgaged, with first home buyers generally holding their own at 23.5% of sales. In the Wellington region, first home buyers have gone from strength to strength, with over 28% of sales for this group since the first lockdown began. As has been the case for a while now, a lack of listings continues to play its part in protecting values from falling away, and this is certainly the case across Wellington. In fact, a shortage of advertised stock is the most dire in Wellington, with total listings down 17% in the last year and a whopping 65% down over the last 5 years. It's going to take some turnaround in the listings to market to change this chronic shortage. From a broader economic perspective, most interest has been in the Reserve Bank's latest monetary policy statement. Unsurprisingly, they chose to keep the official cash rate at 0.25%. However, it was a surprise to see the cap for the asset program extended, but extended it was, to the tune of $100 billion no less. As the Reserve Bank themselves point out, this is to give them the ability to directly keep interest rates low and reaffirms the outlook for mortgage interest rates to remain low for a long time. Add to this a further commitment to support the lending market by way of a funding for lending program, whereby they would fund retail banks directly at near OCR, and it's pretty clear availability of credit will not be a problem through this recession. No doubt, the latest COVID cases and subsequent lockdown announcements are very unwelcome for households, the economy and property market though. The Reserve Bank estimated that New Zealand's economy operated at 81% of capacity in the previous alert level 3 and 91% in level 2. So we know businesses and households will feel the effects in their pockets. Once again, we're left trying to estimate how bad the impact will be, dependent on the length of each lockdown, both now and in the future. Another issue that's been raised is the possible postponement of the general election, which would be an added source of uncertainty for the country. However, there are reasons to avoid undue pessimism. For a start, We've successfully negotiated the alert levels before, and theoretically, the restrictions on different industries could be more tailored this time around, rather than the blanket essential versus non-essential. In addition, the government held back about $15 billion of its original relief package for a scenario just like this. So presumably, the wage subsidy could be extended if required. And remember, our public debt levels are still well below many other countries. Meanwhile, an extension of the mortgage payment deferral scheme was already a possibility anyway, so the latest developments could see that push through as well. As per usual, real-time data becomes king. The New Zealand Activity Index isn't quite real-time, but it's much faster than the usual GDP figures. So we'll be watching with anticipation how August plays out from an economic activity angle. But from a property market perspective, the CoreLogic tracking of pre-mortgage activity at the banks is an excellent measure of demand, while the CoreLogic pre-listing series tracks upcoming supply. Lately, there's been a lift of supply at the same time as demand has slowed. Any extension to that trend could be a sign that values would actually soften. It's definitely not a time to have your head in the sand, that's for sure. Make sure you stay on top of everything that's going on by subscribing to the CoreLogic Property Market Podcast and all good podcast players. And bookmark the research tab at corelogic.co.nz, where we regularly publish all our insights as well. Mā te wā.